Ben. All right, Joe, let's move on to the final trade on your list. You've got Nvidia on your list. Microsoft has yanked back the crown to being the most valuable company, but Nvidia is still fighting for that pole position. What's your view on Nvidia and where it goes from here?
Yeah, I'm just back to the keep it simple. Nvidia is the leader in these AI chips. They are doing everything they need to do to maintain that edge. They are working really hard to keep on top of that, and they're making as many chips as they can. Hopefully, they're going to be able to produce even more coming forward. So they had this hit earlier in the year. They weren't able to sell some of these chips to China. They've been able to recover that revenue that they've lost, still growing. Now, maybe they'll get that back at some point. Maybe they won't. I don't think it matters. I think the rest of the world's marketplace is big enough for Nvidia to continue to grow, and that's just exactly what I'm expecting. Keeping it simple, I'm a big believer that these chips were going to be used to drive this new revolution of AI, and that's not stopping anytime soon.
All right, the view is not stopping anytime soon. So, Ben, what does the chart tell us about Nvidia?
You know, this is an interesting chart, Diane, because again, like Amazon, like Alphabet, this has been in an uptrend. It's kind of running into this rally up, pull back, rally up perspective, but it's running into resistance at 142. It tested above that. It's kind of coming back down a little bit. We're seeing the last couple of candles being some deliberation candles right in this 142 range. The high recently here is up around that 150 mark. So it's got just a little bit of room to move to the upside. But if you look at the RSI, you see a pretty strong bearish divergence, price moving higher, but the RSI moving off, especially out of that overbought range. That would suggest maybe that tech investors in this space have been willing to ride this back up to these resistance levels. They're looking at maybe peeling some of that back and rotating to some of those other opportunities, Alphabet, Amazon, and others within the space, and let this settle back perhaps into that support at 130 before they start driving it higher here. At least that's what the technical analysis would suggest here, Diane.
All right, Joe, I'm going to yield the floor back to you. Any final thoughts on Nvidia, Amazon, or Google?
Yeah, that makes a lot of sense. Just final thoughts is there's so many things to be concerned about. Everyone's talking about how the world might be coming to an end, World War III, geopolitical concerns. These tariffs are going to be so crushing. Interest rates are too high. The jobs aren't going to be there. The market just continues to go higher, and it's fueled by this tech revolution here. So I think we're still in the early stages of this tech revolution. Let's just keep it simple, be in these names for the long run.
Even as the company struggles with recent worries over its Chinese business, analysts at Bank of America said in an interview to clients on Thursday that Nvidia is still in the greatest position to profit from the continued excitement around artificial intelligence. The most valuable semiconductor company in the world revealed last week that its quarterly sales exceeded projections because consumers had stocked up on its AI chips before the United States imposed additional limits on exporting advanced processors to China. In an effort to restrict Beijing's access to and use of AI technology, the United States has imposed stringent regulations on the export of these chips to China. This has specifically resulted in limitations for Nvidia on the selling of its H20 processors, which were the only AI processor it was previously permitted to ship to China. Nvidia reported a loss of almost $2.5 billion in H20 sales in the first quarter, and CFO Colette Kress reported a decline in data center revenue in China. The California-based company announced lower-than-expected financial guidance after pointing out that the limitations will deduct about $8 million from sales in the current quarter. However, after an investor dinner with Kress and other Nvidia executives, the analysts at BofA stated that China is now completely de-risked for the company, with no revenues connected to China in their current data center projections. According to the brokerage, any revenues from this point on are incremental, even though there may be rumors of follow-on goods for the $50 billion AI total addressable China market. Nvidia has been working on a Chinese version of its Blackwell chips, according to Reuters. The analysts contended that Nvidia now has access to prospects abroad because to U.S. President Donald Trump's decision to abolish a so-called AI diffusion rule that would have restricted the international flows of American AI chips. Nvidia signed several agreements in the Middle East last month, one of which was for a 10-square-mile data center in the United Arab Emirates. Saudi Arabia has also seen the signing of other accords. Despite significant volatility in the global market, the BofA analysts kept their buy recommendation for Nvidia's stock, which has increased by 2.6% this year. The analyst set a price target of 180 for the company and referred to it as a top pick in the semiconductor industry. Nvidia's stock closed at $141.92 on Wednesday. So what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Pure play is, at this point, Nvidia. They have the chips people want that are willing to pay up for their premium pricing, and it looks like there really is no substitute at this point. So if you want a direct line to all manner of AI, the way to play it is Nvidia right now.
And when you think about the growth prospects for Nvidia amid some of the geopolitical tensions, obviously Nvidia getting caught in the crosshairs on chip export curbs between the US and China, how concerned are you about the Chinese market getting cut off from Nvidia as a potential downward catalyst?
I'm not particularly concerned, but the company sure is. The last time Jensen Huang was on TV, he was making a direct appeal to the government to allow for export. He always points out 50% of the AI is being developed in China, and wouldn't it be nice to have a US-based hardware platform that it's being developed on? And right now the answer is no, for many reasons. And I think probably the biggest reason is, are they going to just have consumer-oriented AI, or does it have military applications? And that's a tough one to get around. So I think Nvidia making a less capable chip for the Chinese environment is probably the best the company and the government can do at this point, and we'll see if that's permitted in the future.
After releasing its Q1 earnings, Nvidia once again demonstrated to the markets that, despite persistent trade and geopolitical challenges, it is still the clear leader driving the global AI revolution thanks to the unwavering demand for its chips. Even if the momentum slowed down a little in the days that followed, Nvidia's stock had a robust post-earnings rally in addition to surpassing all important indicators and providing outlook that investors found appealing. Nevertheless, it might be argued that one more spark is still required to completely rekindle the stock's momentum as it moves toward 2025. But given the larger growth narrative, Nvidia is still trading at a very appealing price, one that has the potential to generate significant alpha in the future. Although they are worth keeping an eye on short to mid-term hiccups, particularly those related to macro risks in China, do not change the main idea. I still recommend buying Nvidia because of its solid performance and solid fundamentals. As I mentioned in an interview, Nvidia's stock has to surpass market expectations and provide guidance that above expectations in order for its Q1 fiscal 2026 results to be warmly received. And Nvidia accomplished just that. As the chart below illustrates, the company's reported sales of $44 billion exceeded its own guidance of $43 billion, representing a staggering 69% year-over-year rise. With the exception of the H20 charge, a financial write-off associated with its China-specific H20 GPUs, gross margins, which had been a source of worry during the early phases of Blackwell's rollout, came in at 71.3%. Additionally, that exceeds the recommended range of 70.6% to 71%. The Q2 guidance was even more stunning. With a margin of plus or minus 2%, Nvidia is estimating $45 billion in revenue. On the high end, it amounts to $45.9 billion, which is higher than the roughly $45.5 billion average expectation before to earnings day. It is anticipated that margins would increase once more, reaching 71.8% to 72.0% with a 50 basis point margin of error. It indicates another round of margin expansion at the top of that range, which is just what investors were hoping to hear. According to Nvidia, margins may reach 70 to 80% in the upcoming quarters after Blackwell production is fully scaled up. Long-term EPS expectations were raised by almost 9% beginning in FY 2029 as a result of this better-than-expected performance and the margin recovery. Additionally, revenue estimates for those years were increased by about 8%. After the earnings announcement, Nvidia's stock naturally surged over 5% in after-hours trade, but it has since largely bottomed down. The market didn't find enough warning signs to warrant a sell-off in Nvidia stock, Therefore, I think the mild post-earnings reaction is actually a good thing. Bears contend that despite sales increasing by almost 70% year over year, there are indications of growth story weariness, with sequential growth of only 12% possibly suggesting that Nvidia's tremendous momentum is about to enter a more seasonal or plateauing phase. This type of quarter-over-quarter deceleration may be an early warning indicator for a business that is priced for hypergrowth. Geopolitical and regulatory pressures are beginning to have tangible effects, so it's not just about the statistics. Nvidia had to forgo an estimated $15 billion in possible sales to China as a result of the U.S. export limitations on AI chips like the H20, which resulted in a $4.5 billion write-down. Not only does that have a short-term financial impact, but it also gives rivals like Huawei an advantage, particularly if they speed up their own chip development. Even though analysts have increased their long-term projections since Q1, there is still a real chance that Nvidia's worldwide dominance may eventually run into problems, especially if regulatory pressures continue. Q1 would have been the first quarter since the AI boom started in which Nvidia failed to achieve sequential growth, even after accounting for the impact of the H20 write-off. Furthermore, even a slight slowdown might be a risk to the valuation of a stock that is valued for perfection. The larger problem, in my opinion, is that this concerns the strategic orientation of American tech leadership rather than just Nvidia. As CEO Jensen Huang has cautioned that the United States may eventually strengthen Huawei and weaken America's lead in AI if it keeps taking this restrictive course without adopting a more balanced approach. As the growth story becomes more complex, bears are likely to seize onto that type of long-term headwind. However, putting the macro uncertainties aside, Nvidia's bull thesis is still strong following Q1, particularly in light of its growth. The business remains unique as a GARP growth prospect at a fair price. At 31.6 times forward earnings, Nvidia is currently trading at a consensus growth rate of 29% CAGR for the next 3 to 5 years. This leads to a PEG ratio of only 1x, which is much lower than the majority of the other Magnificent Seven stocks, and nearly comparable to Advanced Micro Devices, AMD, despite AMD's much slower growth projection. Naturally, Nvidia's growth trajectory must continue to be solid and clean for that valuation to stay up. But to be honest, it's difficult to imagine any business that trades at such an alluring growth-adjusted valuation, has Nvidia's size and scale, this degree of fundamental quality, and such extensive exposure to secular tailwinds like AI. There is very little doubt among the 40 experts who have written about Nvidia over the last 3 months. Just 4 recommend holding the stock, compared to 35 who recommend buying it. No analyst has given Nvidia stock a sell rating. Nvidia's average stock price objective is currently $173.50, suggesting a possible 22% increase from the current share price. Nvidia crushed its own guidance and delivered a Q2 estimate that dispels questions about how soon gross margins are returning. So putting one-off events aside, the bears had very little to complain about. Even though concerns like changing U.S. sanctions on China, Nvidia's capacity to stay in that market, and growing local competition are important to monitor, they don't exceed the risk-reward of going long at this time, particularly considering the company's robust growth track. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video.
Look, we think about how Nvidia helped the market recover. We saw the numbers looking good. What about Broadcom as well? We're still going to get AI optimism there?
Yeah, so thanks for having me, Caroline. And I think, to your point, I think it's going to be very strong. We're looking for top line growth of about 20% here for the April quarter. And listen, I think when you kind of look overall, the trends that we've seen here over the last couple of weeks, or since Q1 earnings season, really starting with Alphabet and Microsoft at the start of earnings season up until Nvidia last week. The trend on the compute side of things is, I think, much stronger than anybody had anticipated, and really something that Jensen Huang last week really pounded the table on. So when you kind of think about the drivers here, specifically for the AI semi names here over the next couple of years, it really is going to be tied to compute, and the higher demand for compute is going to drive higher capital spending plans, right? Yeah. Which is what we saw during Q1 earnings season. So we think those trends remain intact here for Broadcom specifically. They've got about a 60-40 split in semis versus software. So the semi side will continue to drive that demand, but software shouldn't be ignored because the profitability there and growth continues to be very good.
I mean, we're expecting strong things from Broadcom. You too. Look, your top semiconductor names are Nvidia and Broadcom, AMD, Marvell. I'm looking at how much some of those names have already driven the S&P 500 recovery. A great chart from Ryan Story shows that Nvidia makes up 12%, basically the S&P 500's rebound since April. But swiftly after them was Microsoft, that you named as being a winner of late. Broadcom, some 5%. But is the valuation getting a little too rich now, given the amount of geopolitical anxiety we're just talking about with Liza Tobin?
Yeah, I mean, I think as far as the valuation is concerned, it's not as attractive as it was 4 to 6 weeks ago. But I will tell you this: the valuations just got just hit basement level values. I mean, you were talking about Nvidia at one point trading about 17, 18 times on our 2026 estimate. They're now closer to about 24, 25 times on 2026 expectations. And I will tell you this, the visibility, again, is improving here. It has improved over the last couple of weeks, whether it be on the trade side of things, improving commentary on trade, or whether it be, just from the reiteration in terms of CapEx spends, plans for some of these hyperscalers. Now, I will say, as far as what to look out for here on the geopolitical side of things, there are a lot of moving parts here over the next couple of weeks. Obviously, we want to hear about the US-China discussions, but as far as semis are concerned, there's a 232 semiconductor investigation that is ongoing right now. We expect to get more clarity in terms of what that's going to look like as far as tariffs are concerned here over the next 2 months or so. So it's wait and see mode, but our view is you're going to see a permanent tariff on the semiconductor industry when that gets unveiled. Our base case right now is about a 25% tariff.
What about the smartphone industry? Because actually Apple has contributed to the reprieve in the S&P 500. It's one of your top names for hardware. But boy, we're wondering whether it's going to get individual tariffs of 25% landed on it. Not to mention maybe Samsung gets the same though.
Yeah, so we're not looking for an individual tariff on that side of things, but our view here is they fall under the national security umbrella of the 232 semiconductor investigation, similar to many other hardware names that are right now exempt from a lot of the tariffs. But that said, if we're assuming something along the lines of a 25% base tariff for the 232. That would imply that Apple probably has to increase the price of its iPhone 17 this fall. Our view is probably along the lines of at least $50 or so. So again, we have to wait and see how all this stuff really plays itself out on the geopolitical side of things. But our view is there's going to be some sort of permanent tariff that goes into effect for the hardware companies, and specifically Apple. And Apple, we think, is best positioned to offset some of those higher tariffs because of their brand recognition and because of their pricing power.
So, Angelo, if an investor doesn't have the exposure they'd like in these names, should they buy at this point?
I mean, I think that's a good question. We look at it right now in the sense that we're looking more for a near-term, digestion period. The dangerous thing with that is you just don't know what you're going to get on a day-in, day-out basis because of the geopolitical environment right now. So if you don't own any of these names right now, our view is you do want to buy some of these AI semi-oriented names because they are going to really drive the earnings potential for the tech sector here over the next 2 to 3 years, specifically Nvidia and Broadcom, as well as some of the other smaller names. But Nvidia and Broadcom would kind of be two of the top names with the best visibility out there. And even if you see some of these negative headwinds, whether it be tied to the 232 semiconductor investigation or something on the trade side of things, ultimately, we think this stuff works itself out, and the earnings potential is so great that 2 to 3 years down the road, these stocks should be significantly higher than where they are now.
According to fresh statistics revealed on Wednesday, NVIDIA's latest processors have improved in training huge artificial intelligence systems, with a significant decrease in the number of chips needed to train large language models. New information regarding chips from NVIDIA and advanced micro devices, among others, was released by ML Commons, a nonprofit organization that provides benchmark performance results for AI systems. AI systems use this data to train. The quantity of chips required to train the systems remains a major competitive problem, even though the stock market's focus has mostly switched to a wider market for AI inference, where AI systems handle customer inquiries. China's DeepSeek asserts that it can produce a competitive chatbot with significantly fewer chips than its American competitors. The findings were the first published by ML Commons regarding the performance of chips in training AI systems like Llama 3.1 405B. Meta Platforms released an open-source AI model with a large number of parameters to give an idea of how the chips might perform at some of the most difficult training tasks in the world. These challenges can have trillions of parameters. Only Nvidia and its partners provided data on training that massive model, and the data demonstrated that Nvidia's new Blackwell processors are more than twice as fast as the previous generation of Hopper chips on a per-chip basis. Rather than assembling homogeneous groups of 100,000 chips or more, the AI industry has been moving towards stringing together smaller groups of chips into subsystems for distinct AI training tasks. Throughout a press conference, stated Chetan Kapoor, Chief Product Officer of CoreWeave, which collaborated with Nvidia to generate some of the outcomes. According to Kapoor, they may continue to speed up or shorten the time needed to train some of these insane multi-trillion parameter model sizes by using a methodology like that. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.